Joining me now to help break it all down, Brian Belski. He's the Chief Investment Strategist for BMO Capital Markets. Phil Blancato is with us, CEO of Ladenburg Thalmann Asset Management. And Lindsey Bell, Investment Strategist for CFRA Research. Lindsey, let me start with you. As Jennifer said, there was a lot of noise in there, right? The one-off stuff that we're sort of accustomed to, but maybe a bit magnified because of some of the headline news as well that we saw. What's your initial assessment?
Yeah, I mean, it's just like last month. There was a little bit of noise in this month's report. Fine. I mean, I think that we all know that the first quarter was a little bit weaker. Action Economics, which are the economics numbers that we look at, is expecting 1.8% GDP in the first quarter, which is obviously a decline from the 2.6 that we saw in the fourth quarter of last year. Look, the consumer, though, remains very strong. The job market remains solid. We'll get more data on that later this week. And it seems like some of these smaller employers are still having a hard time finding workers, which means wages can continue to rise, which is overall a good thing for the economy.
You know, you brought up two very, very great points. I'll ask my friends here in the studio about them. With this jobs picture, guys, we saw ADP today. Exactly what Lindsey talked about. Goods producing jobs. I call them dirty fingernail jobs. 44,000. Mining, construction, manufacturing. That's why those students that Jennifer talked about, hey, why go to school if I can start off with a welding job making 60 grand out the gate? Also, small jobs, small employers, 1 to 19 workers, employees, down. They cannot compete. They cannot pay out the wages and benefits being offered. So there's some good things with this going on, but there's also, Brian, some worrisome things as well.
Yeah, I think so. But really, I think the theme you want to start thinking about when you start to hear these numbers, but especially on the manufacturing side, Charles, is that this theme of what should have happened in 2018 is going to happen in 2019. Clearly, we had a tariff tantrum, and then we had the blowout toward the end of the year. I think people are starting to feel better. And I think the key thing from the Beige book that we saw was two anomalies, right? The government shutdown and the weather in February. I mean, over the last 30 to 45 days, I've had more travel delays than I've had in the last 15 years. And my home state of Minnesota had the snowiest winter, or snowiest February in the history of the state.
I never thought I heard someone from Minnesota complain about snow.
I'm telling you, man, it has been terrible. So, I mean, these things are anomalies, but I think people are feeling better. And coming into this, the economic data has been pretty darn good. I know there's reasons to worry about China and Europe, but here in America, things look pretty good.
You know, I agree with you. One of the gauges I use is, again, since we're all today's theme is anecdotal, President Trump's approval rating on the economy. When that goes up, you really know something's going on because it's not just how people's feeling, but, you know, there's a lot of other noise factors that go into that. That's also been going up, Phil. And, you know, it does feel like whatever was hurting or worrying us is starting to fade.
Well, are we climbing the wall worry and continuing to grind higher, or have we bounced off the bottom, the classic dead cat bounce? The Beige book was interesting. I kind of look at it. You know when you watch an NFL football game and there's those commentators at halftime that tell you what's going on, but they really don't know what's going on? That's kind of the Beige book. There's a lot of anecdotal questions that come out of it. But the key theme, the economy's still strong. And if you strip away everything else, when you look at the wage picture, you look at the ADP number, suddenly you got to go back to where we always start, the consumer. And the consumer at 70% of your economy is healthy with the key, the amount of money we spend on debt services, the amount of money it costs you to finance your debt is as low as it was in the 80s. So the question is, do we have pent-up demand to drive the economy higher, or do we just kind of level off here and see how things go?
Yeah, and Lindsey, we have to have that pent-up demand, I think, is there. Another question that I would layer onto that is the confidence to go out and spend, right? And, you know, we saw in December, I think that it was the media. I'm saying that they almost triggered a recession. And with all the negative headlines, you know, when you see savings go from 6.1 to 7.6% in a single month, that is remarkable, as wages were coming in 150% higher than Wall Street anticipated. That never happened. So do you think consumers are probably now, you know, the dust is settling, going to step up to the plate?
I think they will. This is actually normal course of business for consumers. We just finished the fourth quarter of the year where all the holiday spending comes into play. Then you get into the first quarter and consumers, they take a little bit of a step back, really start paying down those credit card bills that they racked up over the holiday period. I think they will be back in spending and shopping. Once we get warmer weather, they're going to have a catalyst to go to the store, get more apparel, and things like that. I think that you saw online sales really remain strong, and that should be a key theme going forward. We just got some retailers reporting earnings. It was a good earnings season for them. Granted, I know the numbers were off of a low base, but guidance was better than feared, and it seems like the retailers are feeling confident about the future.
Yeah, I think the guidance story of all these names, Kohl's yesterday kind of blew me away because their range, the bottom of their range, was higher than Wall Street consensus for the year. I mean, what industry does that? What CEO goes out these days and gives a range way above Wall Street consensus and a retailer's one that has struggled? To me, that says it all. If Kohl's thinks that they're going to beat the street for the entire year, they must see something that headline writers don't see.
Well, Kohl's did some massive restructuring in terms of their inventory controls and really cut down capacity. I mean, I think the way you play retail going forward is the same theme. Look at all the capacity that's coming out of retail, Charles, and really the theme is that the consumer remains very strong. They're still spending $100, but they're being very controlled and discerning with respect to how they're spending that $100. So $100 is there to spend, so you got to have the best product and the best layout to be able to get those dollars.
Let's talk about the market, guys, because it's meandering. Now, you go back to the start of 2016, this market either goes straight up or straight down. It doesn't go sideways. So a couple of days of this and people start calling me, Charles, what's up with the market? And I'm usually like, well, we went up 4,000 points and we're down one day. But I'll let you know tomorrow. People are getting anxious, Phil. I mean, whether it's logical, whether it's rational or not, when the market starts to even consolidate gains, people start to worry, where's the next catalyst?
Well, markets don't die of old age. That's our old motto, right? So now we're looking for the next catalyst. This was as much a reaction to the overreaction of December. So now we've leveled off. Here's the key. From this point forward, can we get enough solid fundamental data? Think about yesterday's ISM non-manufacturing coming in.
It was phenomenal.
Phenomenal number.
Yeah.
So at our core, can the consumer be the single pillar that drives us higher, or do we need some of the offshore things to come back into play? And truth be told, you don't want to whistle past the grave, right? You want to be at least aware that the China-U.S. negotiation is not complete. We start looking at earnings projections this year of 5 to 6%, top line maybe a little bit higher. Those are not the 25 we saw last year. So in that kind of environment, you got to be selective, but it's not that there's not without opportunity.
I think there's the biggest thing that people are missing, Charles. For a long time in our country, we talked about redistribution of wealth, right? What we're doing right now is we're redistributing positions. Last year, we were still concentrated in a few number of stocks. What's happened this year is the rallies broaden. We're seeing better participation across all sectors. Earnings growth is very strong across certain areas, and we've become the active stock picking environment that we believe is really going to be the next leg for this bull market.
And small cap stocks. I mean,
small cap stocks and mid cap stocks are great.
Lindsey, what do you think the next potential catalyst could be?
I think it's going to be a China trade deal, but I also think earnings. We're going to have to start to see earnings move higher. We just finished the fourth quarter earnings season. As we get into the spring period and we get first quarter numbers, you're going to see optimism hopefully return into management teams' guidance and words as they release those numbers.
What about
Friday's
jobs report, Lindsey?
Yeah, I mean, I think it's going to be another good number. Sure, it might be a little bit of a slowdown from the 304,000 that we got in January, but that's to be expected. But I think you're going to see wages above 3% again for the fifth month in a row, which goes back to what we've been talking about this whole time, the consumer, and it will lead to confidence, and that is going to help lead us higher in the market and in earnings and everything else.
All right, good news will be good news. Thank you all very much, Brian, Phil, Lindsey.